Hey, what is going on, everyone? Today we're going to go through two very basic concepts that you need to have as a first time property investor, especially in today's market. It's very important to understand these. It will help you in the long run and it will also make your property investing journey a hell of a lot easier. So, those two things is one, capital appreciation, two is rental growth. Two different types of investing styles, and they can be chopped and changed however it needs to be, right? If you want to increase your funds and cash that you have on hand, then we can do a few properties at capital appreciation. Perhaps we need to build long-term wealth and sustainability, then we go rental growth, and we can change it and adjust as we build the property portfolio. So what we're going to do today is we're going to go through these two concepts. I'm going to give you an example. I'm going to jump on realestate.com and we're going to go find two of these, or a property for each of these, and really just dive into it. And I'm going to step into your shoes. So we're not going to use any of the fancy platforms. We're going to do it as if I was you. So let's jump into it. What is capital appreciation? Let's move my head over here. So capital appreciation is, as it sounds, right? So capital is the amount of dollars that we have in the bank. So a property maybe has a $500,000 loan and it's worth $700,000. Just from an overview, that's a 200K plus. And that would be capital equity. It's the same thing. So capital can be done. Usually for property, it's equity, but capital can be raising money from investors. Maybe you're buying a property and you're looking for a funder, for example. So someone providing the funds to purchase a property, or you're doing a renovation. So it's a lot of words to do it, but in this case, we're using capital and equity as the same thing. So capital would be the amount in the property, and appreciation is obviously going up. So what it actually looks like is it's going to go on an up trend like this, with value at the bottom and then time on the other axis. And it would be very similar to this. Now, on the other hand, let's go back to capital appreciation. What also happened is, not in a really hot market, but usually what happens with this is rent also has a slower increase, right? So rent, we have the same things, a value over time, and rent has a little bit slower. Where over in the rental growth, it's up like this. So we have huge amount of rents and the time is a lot smaller. But then in terms of the appreciation, so the capital, it goes like this. Now, what is the benefit to all of these? Well, if we're looking at a capital appreciation, we can look at it as maybe my mortgage is $1,000. We're going to do round numbers for the time being. And then my rental income of the property maybe $960. So we can see there that it's only a $40 profit, so positive. But perhaps over the last year, what has happened is the capital appreciation, maybe my house was worth 100,000. That's a zero. And now it's 200,000 with the difference of 100K. And this is that bit, right? So this is the value we purchased here, and now we're at here, and we can see the value is going up relative to the time. This is the whole point of capital appreciation. So in hot markets, often both will go up. So similar to this, I have a graph I'll show you afterwards. But if we need to get money fast, or we need to build portfolios fast for properties, our investors will usually choose capital appreciation. So with this, they then have a 100K equity. We say 80%, video for another time, can be withdrawn. So they will then take 80K out of the house and then put that into buying a second house. And then they do the same thing. So what happens is, if we go on our graph here, we have house 1, let's just use this line, house 2, house 3, and then it gets smaller and smaller as it goes up. That's the whole point of the appreciation. It's to increase faster and make sure we're building the portfolio really quick. And this is where the whole renovation and the BRRRR method comes in. We want to get that money fast. Now, on the other spectrum, we can use this example here again. Let's do this in blue for rent. Now, the mortgage may be, let's just do mortgage may equal, let's go 1,000. But then the rental income may be 1,500. So we have a 500 positive. The response is slow on this pen. So we're $500 positive there. So we can see the difference between these two here. We're looking at 460. So very different scenarios. But when we look at the house at the moment, so maybe we purchased it for $100,000 and now it's worth $120,000 and gives us a figure of 20K. These are, so you can see in standard markets, not booming markets like right now, the two are very opposite, right? One, we have a positive cash flow coming through, a very high positive cash flow, and the other is a slow appreciation, so taking out large sum of money. Now, where this is usually handy is if we've sort of built the portfolio and we need positive cash flow. There are tax reasons and everything, but when we're going through that, we're going through just a very, very high overview on these two methods. We want to stack a portfolio where perhaps we are looking at retirement, or perhaps we want this passive income to start flowing through, and we're slowing down on purchasing the properties. Maybe we're diversifying. In this case, we could purchase 4 of these and we're at $2,000 per week. As opposed to the other one, which, let's hit green again, 4 of these, we're looking at 160 per week. It's a very different. 160 per week compared to 2,000 per week. Difference is they have, what do we put, 80K, 100K, that they can actually take out and purchase more properties. But in terms of the long-term rental income, it's not super effective. So one's sort of more passive. Now, let's put this into an actual example. We are going to swap over and get the keyboard out. What does this look like? Well, let's go in the rental one. Rental usually occurs when we are looking in country town, is a perfect example. So let's jump on realestate.com and we're going to go to Kalgoorlie. So nothing fancy here. The standard, the most popular real estate platform in Australia. So none of these, I'm not using any agent platforms for this example. And we can see we want to go from the lowest to highest. So we want to find the lowest suburb. All this doesn't really matter at this stage. We can leave the filters. And we're just going to go the lowest and highest. And what we're going to look for is something like with a price, just so we can show an example. Let's just do this one as an example. So 335. We can see instantly just with this one, so 520 per week. So 335,000 to buy it, 520. Now this is a good example of the rental growth portfolio. Now you're going to have no strata fees with these types of units up in Kalgoorlie, And if we do a quick calculation, 5% is usually dragged all the way down because that's a minimum deposit. Deposits we'll cover in another video, but let's just go the maximum so we can prove a maximum amount of how much you would be charged for your mortgage, just so we can show the difference at a maximum. We got 335, interest rate's about 5.7. You can obviously get cheaper, but let's just leave it at that. So we're looking at 1866. 1866 for the month. Let's put it into a week. So we're going to divide it by 30s to hit the days, because there's not 4 weeks in a month. Sorry to break the news to a lot of people. Divide by 30, and then we're going to times it by 7. So 435 per week of mortgage. And we can see here we're at 520. Now, there is more factors we can go into. Does it need a rent increase? When was the last rent review? We can go into all of these sort of things, but just from a high end, we're looking at a $90 difference just between these two. Negotiating the price down will help this a lot, which is the whole point of the buyer's agents, which, hey, plug in for our service right there. But you can see instantly, just off the bat, that's a nearly $100. Probably would be $100 after those other factors we've mentioned for a profit. It's a very good example, and usually it's seen best in country towns where there's mining, especially with the mining contracts. You'd also be surprised how many mining companies reach out to our investors that say, hey, you've got a house, let's do a long-term lease for the length of the mining lease that they have in that town. The downside is when the mining lease runs out, maybe not Kalgoorlie because it's so large, you're probably not going to sell the house. That's just the trade-off that you're going to take. The capital appreciation is ridiculously low. So let's look at that. So we've nailed this down we're at about $100 plus per week. Now, if we go to real suburb profile and we just pull up this one here, we're going to go on insights and we pull up a Kalgoorlie. Let's go to this side now. We can see we've had a lot of growth in here, but this page is good for people who don't have access to the back-end platforms, or it's very good for oversight. I mean, it's not 100% accurate, and obviously you can get a hell of a lot more stats, but in terms of just your average investor looking and trying to understand it all, it is great. These two platforms doing these two methods that I'm showing you is good enough. I've done it for the first couple of my properties and it's worked out fabulous. So we can see growth in here. What we need to do is, if we're looking at suburb trends, right? So we can see back in, let's go, this is what, nearly 10 years? We can see in 10 years, this thing has grown 300,000 in price to 400,000 in price. So 10 years, that means we're growing at a $10,000 per year. Not super impressive, right? But we then look at the rental growth rate. We can see 340 it started at, and we're at 650. So that's nearly a double growth rate right there. This is the whole point of the slides that I'm trying to demonstrate here, where you can, usually they're inverse, right? So usually if one's up, the other one's down, or one's in effect and one's not in effect. And that trend pretty much shows all of that. And that is this rental growth portfolio right here. My board's getting full. So usually you could start stacking, you get 10 of these. What do we see? We saw that 100, that's $1,000 per week. If we had 10 properties around that, obviously it'd be a lot higher. We'd negotiate more. You can go blocks of land and you've got a lot more power when it comes to negotiation for country towns. So we can amplify the effects of that a hell of a lot more. So let's look at the other one, capital appreciation. What does this look like? Now, the best example I'm going to give you is an actual house that we've got. I've taken screenshots of everything. I'm not going to go through the realestate.com way. We've done that for the rental growth. I'll show you what the appreciation looks like. When we're doing the capital appreciation, it is usually best to actually use the buyer's agent or use someone who has this inside data, or find someone who has a login. I mean, I'm sure you can find someone and slip them some change under the table, if you get my drift. But let's look at this example that we have here, of real example, one of my portfolios. We brought this in 2022 for $500,000. So we can see here $500,000. We brought it 10 days on the market. We negotiated down to 500, and this is what it looked like at the start. So we came in, we did some renovations. You know, this wall's not here anymore. We've put walls here, that's gone. There's pictures on my Instagram. Feel free to jump on there and you'll be able to see them. And we can see now, not including the renovations that we've done. So we've added a front room. This bit in here is turned into a front room. We've added walk-in, sorry, not walk-in. We've added walls, and we've added a study space in there as well. So we've added theatre room, study space, and the whole thing's been renovated really, so it's a lot higher. But when we're looking at valuations, in the 3 years, this is a medium to high confidence. Ideally, I looked at it and it was about 870 in the current market. And sure, we've had the boom recently, but it's also very important to note that this was predicted in a sense. Right? When I was purchasing this property, I looked at all of this. I looked at the growth rate. I looked at the statistical, the probability, the statistical analysis of everything, and I said, okay, this is a good suburb. Supply and demand is low. Infrastructure is incredibly well. We are central to a lot of the workstations, central to the freeway that was being built at the time. So we understood that it was happening. Just want to put that out there before people say, oh, it's just the boom. It wasn't the boom. It was predicted. Capital appreciation works like that. So in 3 years, 4 years, 3.5 years, it's gone from $500,000 to $855, not including the renovations, which would obviously put it higher. Now, in terms of the rental, so we can see in here, I might actually bring back the drawing pad. Now, in terms of the rental, it hasn't increased a huge amount. So we've obviously been pushing for the renovation because this is going to be an equity redraw on the whole thing. So we understood going in that this property was not a rental portfolio. So we knew straight from the start, these two numbers, it was estimated about 780, 800 before the market shift, is what my calculation said. But we understood there was always going to be about a 300K, right? A 300K push each over this span. So we're looking at about 100K per year at the moment on this property, which obviously we'll withdraw and put into more. Now the kicker is where that inverse relationship comes in is our mortgage is around $790 per week. That's a terrible W. But you can see that's only a $30 profit. So we understood this going in. The whole point was to build up the portfolio. This is what the capital appreciation is. This is essentially a very good example, which is what I'm using it for. This runs at 100K per year that it's getting in equity for not doing anything, and we're just going to pull it out, and then that 100K, so the 300K here, will buy probably 2 houses plus the renovations. So the single house has turned into 2. Now, capital appreciation, the whole point of that, we can see in here, this was over a 3-year span, right? Now we do this again, and we're on year 6, and now we have 4 that's coming from those, right? So now all of a sudden, in that 6 years, 1, 2, 3, 4, 5, 6, 7 properties. 7 properties. And this is the whole point of capital appreciation. If we run the same numbers across it, we're looking at 100 here, 100 here, 100 here, 100 here, 100, 100. So in this time frame, we've made 700k profit, right? I don't know why I was going to count it. Whereas if we had rented it and we're running at $100 per week, that's $5,000, 200 per year per property, times 7, we're looking at 42k. Right? So you can see the difference is very, very big. One, we're trying to leverage debt. We're trying to take out more loans. We're trying to build it fast. The other is sort of cruise control. In that 7 years, obviously, this is a wage for some people. This probably go up because of the trend line. So it'll probably be realistically about 60k. So that's really a whole wage. So in 7 years, you could replace your wage, obviously granting serviceability and stuff. But this is the whole point of appreciation. Now, how you would sort of identify these things is you look at growth charts. Now, Rewa has one. I've taken this out so you don't see the actual suburb. It is north of the river in Perth. But you can see the rental chart here. It doesn't increase a lot. Maybe it's 400 here, and then maybe it's 700 here. So although it sounds like a lot, it's really not that much. The main kicker is between here and this point here. So what's that, 470? Maybe we'll just go 500. And now it's probably around the 900s. So the biggest kicker is there. So the 400k growth trend rate that's happening at the moment with this, as opposed to this. Now, this stat is Perth, and this is the suburb. We can see with the capital appreciation in the Rewa site. So if we go on the suburb profile and go a little bit further down, you can see this growth rate right here. If we open this up, we can see a growth rate. We can view it as a table and compare it to the local resident, the main towns of the Goldfields area. And you can see the growth rate in here as sales and then as rentals. Doesn't really have it. Now, with this property, obviously the big kicker, we ideally want to look at a 5-year minimum. Ideally 10 years is the best. So every sales cycle is about 10 years, and that just accounts for our up and downs and our hot markets, our cold markets. So we can still see this is running at a 60% growth, 6%, not 60, I wish. This 6% growth rate, this property. So every year it starts at 100, and then we're at 106, and then we're a little bit further, like 113, 114, and it just keeps going up and up from there, except the entry point is at 400. And that's how you can really look at the growth rate for the appreciation. Just keeping in mind, we want to look at the long-term one in here. So you can see with Kalgoorlie, remember the Kalgoorlie was the opposite. So a low capital appreciation, but a high rental growth, 2.4%, compared to this one, which was at a 6%. So nearly triple the appreciation. And that's how you do the two main factors between it. Now you could go and do this, or if you need help with any of this, feel free to reach out to myself. Me and my team help, and we do this every single day. Usually this question is floated to, it should be most buyer's agents, but we definitely do it. We float this question: do you want to build this portfolio? Are we at the moment, are we in capital appreciation stage? What do we want to do? What's the goal? What's your 5-10 year goal? And we ask all these questions and identify properties based on this sort of information. So if you need help with that, reach out. I've got the calendar link down in the bio We can have a chat, completely obligation free. And if I really hope this helps people just clarify it, and you can now go into the market and say, look at your own position and say, okay, I actually think I need capital appreciation. I need more portfolios. I have the serviceability. I have everything in here. Let's start adding some flipping. Let's do some investor and really build this portfolio that I have. And I hope you can discern what you need personally, and then you can use some of the tips I've given in here to actually go out and do it. So hope this helped everyone, and I hope you have a fabulous day.